Nitin Aggarwal is the head of BFSI and research at Motilal Oswal here to talk about the earnings. And Nitin, I wanted to start off with Kotak Bank in particular. Given the fact that it has been a fairly decent quarter for the bank, what's your outlook on the kind of reaction that the stock is seeing in today's trade? Because asset quality has been fairly strong, and the general view is that we will see momentum continue to improve.
Yeah. So Kotak Bank reported fairly good numbers. In fact, the other income has driven a beat to our numbers. And there has been a compression in margins, but that was pretty much on the expected lines. And that's something we are seeing across many other banks now. And but I think today's reaction is more to do with the fact that going into the results, the stock has been doing very well over the past couple of days and weeks. And even our rating has been neutral on the stock, because if you look at Kotak is relatively expensive in the sector still, and which is where the upside that we are looking at in the stock over the next 1 year is still limited. And so which is where I think we still prefer some of the other large banks over Kotak.
Is there a case for larger banks now to do significantly better than small and mid-tier banks? Because that seems to be the trend, at least in profit. Small banks are losing CASA, their NIMs are peaking out, even though growth may be comparable, but the bases are so large that that may not be a fair comparison.
Right, which is there, yes, because as you move forward, while a large part of the deposit repricing has happened, and that is showing in the cost of deposits, and there's a fairly high differential now between where the large banks are and where some of the small and the mid-sized banks are. But incrementally, large banks are still better placed, because despite the earning compression that we are looking at, like if you look at our report, we have put out the earning growth by Q4, because we give out the quarterly trend in our reports, is going to just fall flat by Q4. And that's something similar to what we are looking at the compression for the other banks also. So not at the same magnitude in terms of growth, but that directionally every bank is going to show moderation. But large banks overall are still looking to do better on the full year ROAs and ROE. And which is why, given the growth that we are looking at and the other operating metrics and the return ratios, they still look better in the sector.
Banks is the consensus view. Everybody has a major ownership in banks. And typically we've seen consensus never plays out.
Mm-hmm. Yes, I have seen that at times, but there have been times where it has not worked also. If you look at last 3-4 years, ICICI Bank has been a consensus buy stock. And that has been one of the best performing stock in last 3 years. So I think there'll be exceptions to that rule. And the returns overall can still lag ROE at the sector level, which is what we think may happen this year, because you are now looking at FY24 from a viewpoint that earnings will keep on moderating every quarter. And margins also will keep moving down. The best of the asset quality, the credit cost that we have seen is likely behind. If you look at Q1, in general, there has been some fairness that you are now seeing coming into the credit cost part. And going forward, while it's tough, the overall credit cost may still remain pretty much in control, but we are not looking at that decline anymore in particular, what we have been looking at in the prior years. And which is where the re-rating that you can look at the sector will still be limited from here. And that's where we believe that the sector return can be lower than the ROE now.
Okay, fair enough. Let's also get in a take then as to what exactly you're anticipating going down the line. After the kind of quarterly numbers that have been delivered this time around, what's the expectation going into the next quarter? Do you believe that we will continue to see healthy loan growth across the board? Can you break it up in terms of which banks could positively surprise on the upside?
I think growth is still going well for the sector. If you look at Q1 itself has been stronger than how the trends typically are in the first quarter of the year. And we have seen a good pickup in deposit growth also at the sector level in Q1. And which is where we think that the growth numbers per se for the sector will still be broadly as per the expectations, and they should track well. We are not comparing loan growth to FY23, because FY23 was a very strong year in terms of loan growth. But for the year, probably 13.5% sort of credit growth for the system looks likely, and wherein private banks will be doing better than that. So they could probably be in the 17 to 18 range in the sector level. And but it's mainly to do with the earnings and the margins, wherein we are expecting moderation to continue. Probably the 2Q margin compression at the sector level will be higher than what we are looking at in Q1. Now, some banks who have already taken a big hit in Q1, of course, they will do a more calibrated fall. I'm mainly like there have been only few results that have come till now, and if you look at AU Bank has reported a 38 basis point compression in margins in Q1. So the bank has been guiding for a more calibrated fall in margins from here. But for the sector, I think the Q2, the decline will be more than Q1.
And let's get in a sense when it comes to growth as well, because there's different commentary coming in from the likes of an HDFC Bank. They're saying they're letting the business go on the corporate front, due to some mispricing. ICICI Bank is talking about a 20% growth for corporate. What's your outlook on the kind of commentary?
Yes, I think every bank looks at their growth opportunities given how the market pricing and the opportunities that are coming their way, and that's how they evaluate the growth. So we have seen some differences in terms of growth rate across banks in different quarters. But by and large, we think the growth rates will stay healthy for the year. HDFC Bank this quarter was, yes, cautious in the corporate loan growth when we have seen a sequential decline, in fact, in the corporate loan book. But over the year, particularly for the second half, we are expecting the overall loan growth to recover. And which is where, if you look at the loan growth that we are penciling in, is close to 17% CAGR up till FY26.
I mean, I look at the economy. The economy is doing okay. Rural income is under pressure. The agrarian economy is under pressure. There are job losses which are happening in the IT world. New job creation is a problem. But if I look at the numbers from banks, they're going gangbusters, 15-20% credit growth. So I'm just trying to connect here. Whom are these banks lending to? Because I don't see too many options available at least.
Yeah, actually, there has been a disconnect, and we have also tried to find that answer with different banks. But if you look at HDFC Bank, which has been having the largest portfolio on the CRB within private banks, it has been growing at almost around 29% in the CRB portfolio. And the bank continues to guide very steady growth for the next 3 years. So I think a combination of low penetration, geographical expansion, and even the new branches that these private banks are opening at a very high rate. And a lot of this credit generally gets originated from the branches. It's not driven from the, say, head offices or the main centers. It's mainly the branch driven. And that is enabling these banks to report healthy numbers when it comes to the retail and the rural credit that they are delivering. And going forward, I think that as that continues to gain traction, we are looking at continued branch expansion at a much higher rate than what we have seen in the prior years by almost all the top private banks. I think that will be one of the key driver of credit on that piece. On the corporate, I think growth overall may still remain controlled. We are still looking at moderate pickup in capex, and probably as you go forward in FY25, post the general elections, you can see some more activity there. And which is why we are still looking at a credit growth lower than what it was in FY23.
Sure. Great to have you, Nitin, with those thoughts on the show. Thank you so much for taking the time out.
Thank you so much. Thank you.
Let's move on. Let's discuss